Let me ask you something. Have you ever felt like you were playing a friendly game of chess, only to realize the other person was out to win at all costs? Well, that's a lot like what's happening right now between the U.S. and China. And if you're just getting into investing, this is one of those big global moves you've got to keep an eye on. Let me break it down for you in a simple way. It all started on April 20 when the U.S. decided to hit the world with a hefty tax increase. But the real target was China. The U.S. slapped a 34% tariff on Chinese goods. And while the original plan was to go as high as 67%, they pulled it back. But you know what happens when you poke a bear, right? China fired right back just 2 days later with its own 34% tariff on U.S. imports. And to turn the screws a little tighter, they decided to limit exports of rare earth materials, which are key to so many U.S. industries. Now, Trump wasn't about to back down. Just 2 days after that, on April 6th, he warned China that if they kept fighting back, he'd push tariffs to 50%. He even tried to pressure China into selling major platforms like TikTok to American companies. It's like a high-stakes poker game where nobody wants to blink. But here's the thing. This fight feels a lot different from the last big showdown in 2018. Back then, the U.S. and China were like two heavyweights in their prime, throwing punches but strong enough to stay on their feet. The global economy was booming, and both countries had solid footing. But now, it's 2025, and both giants are limping from the bruises of COVID-19. It's like watching two tired boxers trying to throw knockout punches. China's economy has been sagging, with house prices dropping and people too cautious to spend, and the U.S. is feeling the pain too. It's not just about flexing economic muscle anymore. It's about survival. So, why does this matter to you as a beginner investor? Because understanding these big moves helps you see how they trickle down to the stocks you're holding or the ones you're thinking about buying. The real winners in investing are the ones who spot opportunities where others see chaos. Tell me, have you ever made an investment decision based on news like this? Just comment 1 if you have, or yes if you're ready to learn how to turn this turmoil into an opportunity. And stick with me, because what happens next is even more fascinating. Now, imagine you're sitting at the poker table. The stakes are high, the tension's thick. And just when you think you've got a solid hand, the person across the table does something completely unexpected. They push all their chips to the center and say, "I'm all in." That's exactly what China did on April 7th. And if you're curious about why everyone's so rattled, let me explain it in a way that's easy to understand. China decided to sell off a massive amount of U.S. Treasury bonds. Think of these bonds like IOUs the U.S. gives out to borrow money. They're considered some of the safest investments in the world. But when China, one of the biggest lenders to the U.S., starts dumping them like they're on fire, people pay attention. Now, why is that such a big deal? Let me share a little story. Imagine you lend a friend some money, not a few bucks for lunch, let's say, a sizable amount. And then one day they come to you asking for more, but you're not sure they can pay you back. So you decide to sell that IOU to someone else, even if it means losing a bit of value, just so you're not the one holding the bag if things go south. That's what China just did. China holds an enormous amount of U.S. debt. Officially, the figure stands at around $761 billion. But some estimates say it's closer to $1 trillion when you count everything up. And on April 7th, China decided to start cashing out. You see, bonds are like seesaws. When the price of bonds drops, their yield, basically the interest rate, goes up. So when China started selling off these bonds, the prices tumbled and the yields shot up. It's like the playground suddenly tipping so hard you nearly fall off. And here's the kicker. Higher yields mean it's more expensive for the U.S. government to borrow money. Now, why would China do something that drastic? Well, it's a calculated move. By selling off U.S. bonds, they're trying to hit America where it hurts in the wallet. You remember how Trump was trying to push China around with those tariffs? This is China's way of saying, we can make things difficult for you too. Think of it like a tug of war, each side pulling harder and harder until something snaps. And right now, it's the U.S. economy that's feeling the strain. The U.S. government needs money, lots of it, and not just for everyday operations, but to refinance over $8 trillion in debt this year. When you're looking to borrow that much money, you want interest rates to be low. It's like wanting a cheap mortgage when you're buying a house. But China's move has the opposite effect. By selling bonds and causing yields to spike, they're making it more expensive for the U.S. to borrow. It's like someone hiking up the interest rate on your loan just as you're about to sign the papers. Painful, right? Now, let's talk about the bigger picture. Why does this matter to you as someone who's just getting into investing? Well, when big players like China make these kinds of moves, it sends ripples through the entire financial system. And those ripples eventually reach the stocks you're watching, the bonds you're considering, even the gold and crypto you're curious about. But here's where it gets really interesting. China isn't just trying to make things difficult for the U.S. for the sake of it. They're playing a long game. And if you're smart, you can learn to do the same. Think of it like this. You've got two heavyweight boxers in the ring. They've both taken a lot of hits, especially after COVID-19. But while the U.S. is trying to find ways to borrow money and keep its economy moving, China is trying to protect its own financial interests. And sometimes protecting what you have means making life difficult for your opponent. The key takeaway here, even when it feels like the big guys are battling it out on a whole different level, there's always something you can learn from their strategies. And the smartest investors aren't the ones who try to outfight the heavyweights. They're the ones who learn to navigate around them. Now, you might be wondering, what should I do with all this information? And that's a great question. Because as a beginner investor, your goal isn't to try to take on the giant sites to spot opportunities where others see chaos. For example, when China dumps U.S. bonds, that drives up bond yields. Higher yields can make bonds a more attractive investment compared to stocks. But it also means companies that rely on borrowing money might face higher costs. And you, as an investor, can use that information to make smarter choices about where to put your money. Here's a little secret. The people who do well in times of turmoil aren't necessarily the ones with the most experience or the biggest bank accounts. They're the ones who pay attention, stay curious, and aren't afraid to make a move when the time is right. So, here's my question for you. If you had to choose between betting on bonds, stocks, or even gold during times like these, which would you go for? Just type yes if you're ready to learn more, or share your thoughts below. And stick around, because what's coming next is even more critical to understand. Let me ask you something. Have you ever tossed a stone into a calm pond and watched the ripples spread? It's fascinating, right? How something so small can send waves so far. Well, that's exactly what's happening now with China's decision to dump U.S. bonds. And if you're investing or just thinking about starting, you need to pay attention to those ripples because they're heading straight for the markets you care about. So here's the situation. China's move to sell U.S. bonds isn't just about flexing economic muscle. It's about sending a message. And that message is being heard loud and clear by investors all around the world. But the real question is, what happens next? Let me take you through it step by step. You see, when China starts dumping U.S. bonds, it makes borrowing more expensive for the U.S. government. And that triggers a chain reaction across the entire financial system. It's like setting off a domino effect, and everyone's trying to guess where the pieces will fall. Now, here's where it gets really interesting. Whenever there's instability like this, investors tend to get nervous. And when investors get nervous, they start looking for safety. Traditionally, that means running to what are considered safe haven assets, things like gold, U.S. Treasury bonds, ironically, or even the U.S. dollar itself. But wait a minute. If China's dumping U.S. bonds, does that mean Treasury bonds are no longer safe? Not exactly. It's more complicated than that. Sure, bond prices drop when China sells them. But rising yields also make bonds more attractive to other investors because they offer better returns. The tricky part is figuring out what's really going on beneath the surface. And here's where you, as a smart investor, have the opportunity to think ahead. Picture this. You're at a carnival, standing in front of one of those funhouse mirrors. You look at yourself, but the image is distorted. Some parts are stretched, others are squished. The market is kind of like that right now. What you're seeing is real, but it's distorted by fear, speculation, and reaction. One of the biggest distortions we're seeing right now is how the stock market is responding. When China makes a big move like this, it doesn't just stay confined to the bond market. It spills over into stocks, real estate, commodities, pretty much everything. Think about it. If bond yields are rising because China is selling off U.S. debt, companies that rely heavily on borrowing start feeling the heat. Higher borrowing costs mean lower profits. And when profits drop, so do stock prices. But there's more. When investors start selling stocks out of fear, it creates even more panic. And that panic, in turn, drags down the value of things like 401k retirement funds. You've probably heard about 401x before, right? They're one of the most common retirement investment vehicles in the U.S. They're packed with stocks, bonds, and other assets. And when the stock market takes a hit, so do those funds. Here's a little story to help you see the bigger picture. Imagine you're at a party. Everyone's dancing, having a good time. Suddenly, someone yells, "Fire!" Even if it's just a prank, people start panicking. They push, shove, and scramble to get to the door. That's what happens in the stock market when uncertainty takes over. It doesn't matter if the fire is real or not, fear takes the wheel, and everyone tries to get out at once. The thing is, when people sell off their stocks in a panic, it often creates opportunities for the calm, patient investor. It's like a clearance sale at your favorite store. But the key is knowing which items are worth grabbing and which ones are just going to sit on your shelf gathering dust. And here's where I want you to start thinking like a seasoned investor. When China dumps bonds, when markets tremble, that's when the true opportunities start to reveal themselves. Stocks that were overpriced a month ago might suddenly be a bargain. And if you're prepared, you can make decisions that set you up for success down the line. But here's something else you should know. This bond sell-off by China isn't just making investors jittery. It's stirring up political unrest, too. In fact, there's already talk of protests and demonstrations in the U.S. People are upset about Trump's aggressive trade policies, worried about their investments, and fearful for the future. And when unrest spills into the streets, it only adds more uncertainty to the markets. You see, when a nation's political stability feels shaky, it shakes up everything else, too. And when people lose confidence in their leaders, they often lose confidence in their investments. Bhutan, this is a big but if you know how to read the signs. You can actually use this volatility to your advantage. You've heard me say it before. In times of turmoil, the best opportunities often hide right under the surface. It's like finding diamonds scattered on a battlefield. While everyone else is focused on the chaos, you can be the one quietly picking up valuable assets at a discount. But before you start diving in, you need to know what to look for. And that's exactly what we're going to talk about next. Because the way you handle your investments during turbulent times can make all the difference between building wealth and watching it slip through your fingers. Now, I want to hear from you. If you could pick just one asset to invest in during times of market chaos, whether it's stocks, bonds, gold, or even something else, what would it be? Just type yes if you're excited to find out more, or share your thoughts below. And trust me, you're going to want to stick around for what's coming next. All right, you've made it this far. By now, you know that the U.S. China economic battle is more than just a headline. It's a domino effect, sending shockwaves through the markets. But here's the real question. How do you make sure those shockwaves turn into opportunities instead of setbacks? Think about it this way. Whenever there's chaos, there's always someone quietly picking up bargains while everyone else is running for the exits. It's like walking into a fancy store right after a big sale has started. Sure, some shelves are a mess, but there are still treasures waiting for someone smart enough to spot them. And right now, that smart person could be you. Let me take you back to where we left off. With China selling U.S. bonds, bond prices are dropping and yields are spiking. That means it's becoming more expensive for the U.S. government to borrow money. And while most investors are biting their nails, worrying about what comes next, this could be your moment to strike. But how and where? There are a few critical things you should be thinking about. First, let's talk about the stock market. Yes, it's been taking a beating lately. And whenever the market trembles, there's a tendency for everyone to panic. You've probably heard the old saying, buy when there's blood in the streets, even if it's your own. It sounds dramatic, but it's true. Historically, the most successful investors have been the ones who kept their heads while everyone else was losing theirs. But here's the trick. You need to be selective. When panic selling hits, it doesn't just drag down the weak companies, it pulls down the strong ones, too. And that's where you come in. Imagine you're on a treasure hunt, but instead of looking for gold coins, you're hunting for companies that are fundamentally strong but temporarily undervalued because of all this chaos. Maybe they're solid, well-managed companies with good revenue streams, strong customer bases, and little debt. But their stock prices are dropping simply because everyone else is running scared. Think about companies like Apple or Microsoft. They've weathered countless storms and always come out stronger. They're like sturdy ships sailing through rough seas. Sure, the waves might rock them a bit, but they don't sink. Those are the kinds of companies you want to keep an eye on when the market is shaking. Now, let's talk about bonds. I know bonds don't sound as exciting as stocks. But here's the thing. When bond yields go up, it can create some real opportunities. Remember, bonds are just loans made to the government or companies. And when yields rise, it means you're getting paid more for lending your money. If you're someone who likes the idea of a steady, predictable return, this could be a great time to start considering bonds as part of your portfolio. But again, you have to be selective. Just because a bond's yield is high doesn't mean it's a good deal. It's all about understanding the risk. And if you're willing to do your homework, you can find some solid investment opportunities in the bond market. But let's not stop there, because this crisis is creating opportunities across multiple asset classes. And if you're serious about investing, you got to be willing to look at everything. Stocks, bonds, gold, even cryptocurrency, each one offers different opportunities depending on how the market is moving. Let me share a little secret with you. During times of crisis, gold often shines. Why? Because when investors panic, they rush to what feels safe. And gold has been seen as a safe haven asset for generations. When stock markets drop, gold prices often rise. But here's where it gets tricky. Just because gold is popular during uncertain times doesn't mean it's always the best investment. You've got to keep an eye on the broader picture. Now, let's take a moment to talk about something newer on the scene: cryptocurrencies. They're volatile, no doubt about that. But for some investors, that volatility isn't a reason to avoid theme, it's an opportunity. When markets are shaky, some people turn to assets like Bitcoin as an alternative to traditional investments. Sure, it's risky, but sometimes calculated risks are where the greatest rewards are found. The point is, there's no one-size-fits-all approach here. The best investors are the ones who keep their options open, who diversify, and who are willing to take smart risks when the time is right. And that brings me to the most important point of all: preparation. The truth is, you can't predict exactly what will happen next. No one can. But what you can do is prepare yourself by learning, observing, and being ready to make calculated moves when the time feels right. You see, investing is like surfing. The waves will keep coming, and you can't control them, but you can learn how to ride them. And when you do, you can take advantage of the ups and downs instead of being tossed around by them. Now, here's what I want you to do next. Look at your current investments. Ask yourself if you're diversified enough to handle the ups and downs that are likely coming. And most importantly, be honest with yourself about your risk tolerance. Are you comfortable riding through some choppy waters? Or do you prefer a smoother, steadier path? Whatever your answer is, it's okay. The most important thing is to be clear about your goals and stay consistent. And if you're feeling overwhelmed, remember you're not alone. Everyone starts somewhere. Even the most successful investors began as beginners, learning step by step. So here's my question for you. Which investment are you most curious about right now? Stocks, bonds, gold, or cryptocurrencies? Just type yes if you're excited to learn more, or share your thoughts below. And if you're feeling brave, tell me which one you're most interested in exploring. Because trust me, the best time to start learning is right now. And don't go anywhere, because next, we're going to dive into some real-life strategies you can use to start turning these global tremors into golden opportunities.